Thank you all for coming. Whoops. Love the energy. Happy holidays, Happy New Year. It's really great to see another packed house. You all were the lucky ones. We had to actually turn a few people away. We oversold, so we've got to figure out how to get the Bogey Club to do an expansion so that we can fit some more. Analysts in the early 1990s were predicting the future of the internet. And looking back on it, even the most bullish analyst, meaning the most aggressive of what would change, sorry, yeah, I kicked that right away, weren't bullish enough. I mean, the internet has changed every facet of our lives. Where they were wrong is on the timing. A lot of times people in the 1992 and 1993 thought everything was going to happen within the next 5 years, and it's still changing today. But if you think about a company like Netflix that has revolutionized the whole industry, it opened in 1998. The first year it started streaming was 2007, and it actually stopped mailing DVDs in 2023. So that kind of evolution, the analysts were right. Everything changed, but it took a lot of time to get there. And when we think about artificial intelligence, we think it's going to be similar. It's going to change every aspect of our life, just like the internet did, but it's going to take some time. It's going to revolutionize different industries at different times. There's going to be fits and starts, and that provides a lot of opportunities for stock pickers. So that's what we'll be talking about today. I'm Logan Finerty, the president of Argent. Again, thrilled to be here. We have three other speakers coming. Steve Finerty and Ken Crawford are going to talk about the markets, the economy, and Argent's performance. Jed Elllerbrook, our large cap portfolio manager, he's going to come in and do the deeper dive on AI. So if you're here for AI, you're going to be most excited when Jed's up there. And then I'll bat cleanup. Really, my job today is to set the table, because we have people here today that use AI maybe every hour of their job. And we have others that haven't used it. And we learned back, I think my first presentation ever here was on quantitative easing, which is just about interest rates. And the presentation, in my opinion, went phenomenally well. We said every word in the right order, the slides were perfect, everything just worked. And I turned to the person next to me after the presentation, fishing for a compliment, and I said, "So what do you think?" And he goes, "The steak was really good, but what's yield?" So we did a whole presentation on interest rates, using the term yield interchangeably with interest rates, but never defined it. And the guy next to me missed at least 20 minutes of the presentation, didn't know what was happening. So my job here is to level set, make sure we're all using the same language and we understand, so that when Jed gets up here, we can understand what the guru is really talking about. So Argent was born in 1998, just like Netflix. I guess it was a good year to start a company. And we manage $4 billion of US stocks. That's what we do. We manage it across market caps, large to small. We also have a high dividend strategy focused on more cash generation, maybe a more sleep at night portfolio called Dividend Select. We do have most of our assets are in individual stocks, but really most of the new assets, the new flows, are coming via ETF, which is like a mutual fund, where we have that for our large strategy, mid, and small. And the stock price is around $30. That's what people like about it. They can get in at a very cheap price, and they get the full Argent exposure behind it, and it's a very tax advantage structure. So anyway, that's a little bit about Argent. In terms of artificial intelligence or AI, there's a few things to know. First is like, what is it? So if you've ever been to Google and you've just seen the blank page in a search bar, that's what artificial intelligence websites look like today. So if you're on ChatGPT or Claude or Copilot, you hear these terms. Those are the Yahoos and Netscapes and Googles of their time. And it's just a search bar. And you can treat it like a kid without feelings. You can just say whatever you want to it. You can't break it. The way I use it most recently have been a few things. I wanted to go to Japan. I actually went in August. So I got on ChatGPT and I said, "Hey, ChatGPT, I want to go to Japan. I don't want to move around a lot. I'd rather spend more time in one city than see all the highlights. I don't really like museums. I love nightlife. I love restaurants. I want to be able to walk everywhere. I'm not afraid of the subway. Where should I go?" And it interacted with me just as a travel agent would, only it was 10 o'clock on a Monday night and I was on my couch and getting real-time answers. It was an amazing trip, by the way. I'd be happy to tell you about it afterwards. Another recent example, I had a client in yesterday we were talking about this presentation. And they said they used it over Thanksgiving because they had grandchildren with them ranging from age 16 to 2. I forget how many there were, 4 or 5 grandkids, 16 to 2 years old. So they got on ChatGPT and said, hey, I have grandkids in town. Here's the age range. Where should I go in St. Louis where everybody would be happy? Other examples, like at work, we're using it to do drafts of emails. We're using it to look at data. We have it look at SEC filings and corporate earnings calls to look for tone changes. One of my favorites that might be relatable in this room, I know there's a lot of lawyers, is lawyers are putting in the depositions that they have from all the witnesses. And they're just saying, where are the inconsistencies between these depositions, right? So that kind of thing is what AI does. And so if that's what AI does, well, what makes it work? Well, you've probably heard about data centers. If AI is the car, the data center is the highway. That's the infrastructure that allows it to run. And these data centers we're going to talk about a lot. And they are a big deal, and they take a lot of energy, and they're loud, but they're remarkable in what they can do. And then we'll have the most confusing term, I think. You have chips or semiconductors. That means the exact same thing, sort of like interest rates and yield. So chips and semiconductors, and that is essentially the policeman on the highway guiding traffic, doing things so information flows in the fastest, most efficient way possible. So again, AI is it uses the internet, but that's the information we're using. Data centers are the infrastructure, and the chips or semiconductors, more like the policeman. So that's a quick level set on AI. That was either going to be your favorite 5 minutes or your least favorite 5 minutes of the presentation. The rest is a lot more fun. I like to tell people that I know the founder of AI because I was on a water polo team across the street at Burroughs with Sam Altman, who's the founder of OpenAI and ChatGPT. And it's a really good story to tell over cocktails. But the truth is artificial intelligence has been around for a really long time. And to just tee up that concept, we have a very short clip to show you.
That man isn't playing checkers against a computer, is he?
Sure, and it plays pretty well.
Now, which color?
While most computer scientists saw it as a mere number cruncher, a small group thought that the digital computer had a much grander destiny. Being a general-purpose machine, it could be programmed to do things which in humans require intelligence, play games like checkers and chess, and solve brain teasers.
Let's see what it's printing up.
The field became known as artificial intelligence.
Can machines really think? Even the scientists argue that one.
All right. So we'll get into it. First, our chairman, Steve Finerty, and portfolio emeritus, Ken Crawford.
This is kind of the highlight of my career because to be speaking to you when the subject is on computing and AI and technology has got to be the least expected thing that I ever thought I would be doing. I'm from this generation. I remember when things like this were on TV. You probably recognize that narrator's voice. We've all heard it. What was interesting, we did a presentation to a lot of young analysts yesterday, and the average age was probably 30 to 35 in the room. And they looked at this like it was a dinosaur on the screen and things. And I'm thinking, I remember this. This is the type of, I know that narrator. It's been a really good year for the stock market. This is the third year in a row that if you have a diversified portfolio of stocks, you've had a really good year. And my guess is, unless you've gone wild spending money on a new yacht or something, almost everybody in here is richer today than they were a year ago, by probably a fair amount. So it's really been remarkable. But I would also tell you, it's also been one of my most frustrating years, and I think for Argent it's been a frustrating year. Because for the last couple of years, we've been up here bragging about how smart we are, and this year we're underperforming our indexes. So we figured if we're going to brag when things are good, we got to tell you when things are still good, but less good. So how are we doing? And we have 4 main strategies. There's actually a 5th strategy called SMID that's not on here that's doing okay. But large cap, I mean, normally if I said, we're actually a little bit over 10% today, but when we did this, 10% dividend about the same. Those are our 2 big ones. Mid cap has been our star. A year ago, we were up here touting Kirk McDonald as the smartest man in the world. He had the #1 mid cap fund in the country on a 3-year basis. He's not as smart this year. We're about flat. In focus small cap, we also had 2 outstanding years. It just started 3 years ago, and this year it's about flat as we sit here today. So that's below the benchmarks. Diversified portfolio, it's still good. It's upsetting, and we always like to tell people, don't focus too much on the short term, think about the long term, and we mean it, whether the times are good or bad. Long-term things are still working out great. If you look at your last 3 years, and this would be true for any stocks you own at Argent, probably true for stocks you own elsewhere also, 10 to 20% is a range of the average annualized return, one of the great 3-year runs in market history. And when we look at our longer-term performance, our large cap strategy has been around for more than 25 years. Dividend Select, I don't even know, probably 16, 17 years. Mid cap, 11 or 12. Focused only 3 years. But net of fees, we're still outperforming our benchmarks in all but focused small cap. We'll get it back. I wish we had had this presentation 3 months ago. We were ahead on all 4 3 months ago when we started thinking about this. Or I could have showed you an old slide and said, darn it, we couldn't get it updated in time. My marketing skills are slipping. So my purpose today is not to make excuses on why and it's not just us, huge percentage of portfolio managers are underperforming, particularly the large cap and the small cap areas in the US market. But what's going on in the market that's unique this year? And it really is unique. So if you take what's been great, let's just look at the last 6 months. And as I look at our performance, and I look at our competitors' performance, in the first 3 months of the year, we had a good first quarter. We were ahead across the board. We thought we were going to have another great year, relative and absolutely. But then it all changed probably around Liberation Day, which was early in April when the tariffs and things were all structured. So highly shorted stocks have been the big winners in the last 6 months. Not a type of stock that we typically focus on. What's a highly shorted stock? It's a stock that investors are betting is going to go down. And they make big bets on this, big bets. So if you think the market's getting high because some prices are getting out there, you short the stock, and if it goes down, you can make a lot of money. But if it keeps going up, you are losing a lot more money every single day. And that's called a short squeeze. Now, my wife who's in the other room, if I ask her to define it, she would probably say when her 4-year-old granddaughter comes up, that's a short squeeze. But a short squeeze in this business is a little bit different. A short squeeze means they have to cash out the position just like a gambler does in Las Vegas. If you're losing at the tables, at some point, you just got to say enough's enough, and you'll walk away. But when that happens, a lot more stock actually gets purchased as part of the unwinding of that transaction. And it tends to push a highly valued stock even higher. I've been doing this 48 years. I have never seen highly shorted stocks outperforming this much relative to the rest of the market in a short period of time. Unprofitable companies, doing great. And you might think, why would unprofitable companies doing great? And the key is to remember, an unprofitable company is not necessarily a bad company. A lot of great companies started off as unprofitable companies. But what it means is, in today's market, when you think about utilities, new utilities are building nuclear power for the big data centers that Jed's going to talk about and how much power they require. If you're building those today, they're not making money this year. They're not making money next year. They probably won't open for 5 years. They're not going to make money for a long time. And then they may make tons of money. Or they may not. They're a more speculative type investment. But unprofitable companies like that are doing really well. And then volatile companies are doing well, the type that tend to go up and down a lot. So think high reward, but high risk. And I always think, when I think about volatility, a stock like Tesla, which is not a stock that we own. Unfortunately, Tesla's been a phenomenal investment, but think about it, if Elon Musk died tomorrow, what would happen to Tesla stock? I have no idea, but I do know it would be volatile for quite some time. So it's a different type of investment. What hasn't worked the last 6 months? And this looks like it's right out of our prospectus for Argent and the type of things we look at. Profitable, earnings growth, low valuation. Profitable companies are companies that make money on a very consistent basis. Earnings growth, companies that grow their earnings every year. If you're growing your earnings every year, sooner or later, the investors are going to find you. And low valuation means more reasonable price-earnings ratio. For each dollar of earnings, what price are you willing to pay? For some companies that are really growing rapidly, maybe people are willing to pay 40 or 50 times. But for most companies, a 20 to 25 is in the high range of a price-earnings ratio. So those type of companies. Because the ones on the left are doing really well over the last 6 months, and the more typical ones aren't, a lot of people are asking other questions about whether the market's in a bubble or whatever. But first, I want to show you what works long term. This is a 30-year chart, which is the exact opposite of things that have worked in the short term. And it's not that these haven't worked, they just haven't worked nearly as well. But in the long run, and we could take a 5-year chart, a 10-year chart, a 30-year chart, a 100-year chart, they all look the same. This is a 30-year chart. But companies that are profitable, that grow their earnings every year, that have a reasonable valuation, and reasonable does not mean necessarily low, but reasonable, you can justify it. Those are the typical companies that do best. And that's why if you look at your portfolio and you're up 10% and somebody else is up 13% or whatever the number happens to be, that's probably the explanation for it. So is it a bubble? When you get this type of market where these type of things are all screwed up, and a lot of times they're screwed up for a month or two, it's very rare to see it last for most of a year. We would tell you, and the reason Ken and I are going to be talking to you about this is because Ken and I collectively have about 80 years of experience in this business. And we won't debate on who's more of that 80 years than the other, but if we go back to the dot-com bubble, which both Ken and I were managing money in those days, Intel, Microsoft, Oracle, Cisco. Cisco was the Wall Street darling. I'm sure a lot of you in here remember Cisco. I mean, everybody loved Cisco, but it was also trading at about 125 times earnings. There are a lot of big companies that are trading at even higher valuation than this. So these are just big companies. They were all trading 50 to 100 plus earnings. That means you better grow your earnings. You better be doubling and doubling and doubling to justify that type of valuation. And it did lead to a market crash. The average technology stock after this type of performance in early 2000 dropped between 70 and 80%. That's a bubble, that's a crash, and that's what we had at that particular time. But if we look at it today, Alphabet, NVIDIA, Apple, Microsoft, which coincidentally are 4 of our 5 biggest holdings also, so if you're in this room, you probably own a lot of these type of stocks, they're valued between 25 and 30 times earnings, which is high, but it's not crazy high by any means when you look at the growth rate that these type of companies have. And there are a lot of other factors when we look at things that determine is a market too highly priced? Is it really subject to a big downturn? And there are a lot of factors that are still quite positive. And nobody's better explaining a lot of those factors and the economic impact than Ken. So I'll turn it over to Ken and let him walk through some of those.
Thank you, Steve. As Steve said, we don't think that we're in a bubble. This is a chart of the earnings for the S&P 500, large U.S. companies. And there are a few takeaways I would have you note for this. The first is the header, 13% growth. Steve rightly said he and I have a fair amount of investment experience. Logan as well. Jed will talk to you in a bit. If you asked us what would we think about a 13% growth year in earnings, we'd say we take it every day. And think of that also in the context of a very strong 23 and 24, 13% growth is quite good. Expectations for next year, one thing that we know for sure is the expectations will be wrong, but expectations are for another low teens growth year. So a good setup for 2026. Another thing that I think is noteworthy about this slide is the trajectory. So you look at March of 2025, expectations were about for 6% earnings growth, then higher in June, then higher in September, and higher in November. So as the year went along, Wall Street research, Wall Street thinkers said, earnings are going to be better than we thought before. So up into the right trajectory, good for us. What about employment? Trajectory a little bit different, down and to the right. So look at 2021 and 2022 and think about when you were walking around Clayton or Ladue or wherever, and pretty much every place you saw had help wanted signs. The employment picture in the United States was very, very tight. Our unemployment rate was very, very low. And you can see the employment growth that came from that. Most recently, we've had much lower employment growth, and we've actually had negative data points. The Federal Reserve, the organization, the institute that controls the rate of money or the price of money, has 2 mandates, and one of them is full employment. And there are people at the Fed, the Federal Reserve, and there are economists outside of the Fed that say, this is a bad picture. We should be doing something about this. The other mandate that the Fed has is stable prices. And when the Fed says stable prices, they think about inflation. And what do we see when we look at the recent history of inflation? Well, we had the pandemic and the recession that drove. The federal government and the Fed implemented considerable stimulus into our economy to pull us out of that recession, and it worked. But what happened with that recovery was we got inflation. And for the first time in 40 years, the US economy was dealing with this. And I'm sure there are people in this room who are young enough or have kids or grandkids who had to pull out a dictionary when, what is inflation? Prices go, I don't get it. So what did the Fed do? Exactly what you would expect. Hit the brakes and hit the brakes hard. They raised interest rates to try to slow the economy, to try to bleed out that inflation. And they did well. We were close to 10% at the peak in the United States, and it has fallen precipitously since then. However, we're not at the Fed's level of preferred inflation, which is 2%. The last 1 point plus or minus has been difficult for the Fed to extract out of our economy. The personal consumption expenditures index that the Fed pays most attention to came out last Friday, and we were running at 2.8%, obviously above 2%. So what does the Fed do? It wants employment to be strong, and it's getting weak. It wants inflation to be lower than it is. How do they act? What the Fed has been doing is begin to lower interest rates. So in November of 2024, they dropped interest rates by 50 basis points, half of 1%. And as you can see, it had been quite a while since the Fed lowered rates. Since that time, every meeting, the Fed has either dropped rates by 25 basis points, a quarter of 1%, or done nothing. The Fed met yesterday. What did it do? Took another 25 basis points off. So today, the Fed funds rate is running between 3.5% and 3.75%. And people expected that the Fed would lower rates. They also expected that Fed Chairman Powell, during his conference call, would be relatively hawkish and talk about inflation and how we should not expect the Fed to drop and drop and drop. And instead, Chairman Powell was relatively dovish. He was worried about employment. And if you saw the market yesterday, it popped up because he was perceived as less onerous than expected. But what is the Fed going to do going forward? So with that, I'll pull out a note from the Wall Street Journal. So you've got employment weakening, you've got inflation falling, but not to the level that people would like. The Wall Street Journal says the Fed's new interest rate projections underscored this challenge. 7 of the 19 participants at this week's Federal Open Market Committee, that's the group that decides interest rates, thought no rate cuts should be warranted next year. And 4 of them saw no more than 1 rate cut, likely fewer than what the president wants, who constantly talks about lower rates, and a potential conundrum for whoever takes over in May. So there could be a little bit of drama going forward with interest rates and the Federal Reserve. Uncertainty to be sure. Any other areas that we see uncertainty in the world? Tariffs. So our president thinks tariff is the best word in the English language. The vast majority of economists, I think, would respectfully disagree with the president. You can see the trade-weighted tariff being applied to the US goods, and we are at record levels. So why is tariffs not really good for business? Firstly, it's a tax. So imagine you are a St. Louis-based chocolatier, and you're coming into the holiday season, and everybody knows that the best chocolate comes from Switzerland. So what are you going to do? 39% tariffs on Swiss chocolate. Do you buy now and eat that? No pun intended. Do you hope that you can push that higher price to your customers and they will swallow the higher price? Or do you accept lower profits because you've got to take that tariff and do with it as you would? And as you're thinking about this, you see a news item from yesterday. The Swiss government on Wednesday said the tariffs on Swiss products in the US would fall from 39% to 15% retroactively to November 14th, delivering relief to businesses that had been saddled with the highest US duties in Europe. So good news for you if you're a chocolatier, but a lot of uncertainty as all of that is changing. So I think most people, most business people, most economists would like to have a little more clarity about what's going on with tariffs going forward. When we look at construction, what do we see? General office trending downwards. And why is this? Well, again, let's think about the pandemic. For a year or so, those people that worked at home. And then slowly the world recovered and opened. And people said, okay, I'll go back to the office, but this work from home is kind of nice. I'll go 3 days a week, or I'll go 2 days a week. Or if you're still at Finerty, you'll go like every other solar eclipse. And if you're not coming into the office, then you've got empty cubes and you've got empty offices, and you don't need a second floor like you had planned a few months ago, and you don't need a third building like you had planned a few months ago. So general office construction has declined, and we would expect that to continue to decline. And Logan will talk later about how AI might even exacerbate the situation. So pretty tough for construction, right? Well, there is an offset, as Logan talked about, data centers. So these giant buildings, and Jed will give us an example of that shortly, that drive artificial intelligence. And pretty much every quarter, those companies that have more exposure to artificial intelligence talk about increasing capital expenditures. And they don't talk about increasing it by millions or even by billions, but more tens of billions and hundreds of billions. And much of those billions is going to build data centers. So a great offset to the construction industry and a real shot in the arm, and something that we expect will continue for quite a while. So what can you do with artificial intelligence? Well, if you're an old guy like me, you probably got boxes and boxes of photographs in the basement collecting dust and turning sepia colored, the kind that Ken Burns always likes to use with his PBS specials. This is a photo from Trenton, our head of strategy and brand, a longtime Argent employee, and it's a very nice photo of his aunt getting married circa 1954. And I'm sure when Trenton and his family look at it, they get warm and fuzzy feelings, as you would expect. But with the advent of AI, you can take that static picture and make it a living memory. So tonight you can go down to your basement and sift through those photos and pick out your favorites and bring them to life. This is a photo of Jed Elllerbroek. It is not AI enhanced, obviously. What it is Jed getting ready to be on Bloomberg television again, and he was on Friday most recently. And perhaps the novelty of seeing Jed on financial TV is lessening as he's on Bloomberg and on CNBC and on ... But I think you will agree with me when you look at the clip that he beautifully articulates the way we at Argent invest and really crushes the interview on Bloomberg.
Explain what mid-cap and small-cap do. Your heritage is the tangential A.G. Edwards and Wachovia and all that. Jeff Slocum's wonderful shop up in Minneapolis. You people were knee-deep in industrial mid-cap not even small cap, but mid cap America. Does that still lead like the textbooks say?
We think it might, yeah. There are all kinds of wonderful small and mid-cap companies in America. One that jumps to my head is Comfort Systems, which is an electrical contractor that is experiencing the best of times today. It's a wonderful kind of compounder stock, outstanding management from rural Illinois.
Nice.
Company's headquartered down in Texas. But just an example of a great American company. They're helping.
Oh, the symbol is FIX.
FIX, yes.
FIX.
Tom,
Yes.
it's a $33 billion market cap company. How come we've never heard of this thing?
Because we're idiots in New
Jesus.
York, Paul.
Exactly.
It's 10022
I know.
and Jed's wired in.
God.
18,000 people. Houston. Good morning, Brian Lane
Stock's
and Bill
doubled this year.
George.
Jeez.
Stocks doubled?
Double.
Now you have my attention.
123%. Another one I missed.
5 years ago, I was a small cap analyst researching that company in the small cap landscape. So it's just an amazing growth story.
Right.
Their electrical contracting gear is now, or they're doing work now helping to build data centers.
When you're done
course they are.
talking to KMOX, can you come
Yeah.
back and talk to us? Jed, thank you. Jed Elllerbroek with us here from St. Louis, Argent Capital. Comfort Systems, a symbol FIX. FIX. From New York City.
Thank you, guys. That photo of me in the makeup chair is backfired, not just because it made its way into this presentation today, but because I have a 6-year-old daughter who wants the chair and the makeup and the cover for Christmas this year. So we'll see. But I'm here to talk about AI today and just run through some of the interesting and unique aspects of it. As many of you know, AI beneficiary stocks that benefit from the use and deployment of AI, have driven our stock market over the last 3 years. Over 75% of returns are due to those stocks. And even greater, 80% of the earnings growth has come from those companies. And maybe most important, 90% of the capital expenditure growth in our economy comes from those businesses. Capital expenditures is business spending on goods that are useful for more than just a couple years. So think an airplane, an office building, or even a data center. As we all know by now, NVIDIA, the semiconductor manufacturing company, is the biggest AI beneficiary. Here you can see their revenue growth over the last decade, and you see this gigantic hockey stick growth progression. It's grown so large that their profit over the next 12 months after tax, they will be earning $1 billion every 2 days. So when you let that sink in, it's kind of shocking. $180 billion of profit over the next 12 months. That has pushed their market cap north of $4.5 trillion. That's bigger than Germany's economy. Germany is the industrial powerhouse of all of Europe. So kind of amazing growth. It's become the largest company in the world. We're all familiar with it. So who's using these chips and what are they using it for? Here's their CEO, Jensen Huang, holding up one of those accelerator chips. These 3 companies buy a little more than half of them each year. We all know Amazon is the company, the retail sales website. We all know Microsoft is the dominant business productivity software company, Microsoft Excel, Office, etc. And we all know Alphabet or Google as the search bar. They also own YouTube. But what has investors most excited about these companies are their cloud computing units. Those business units build, own, and operate data centers filled with semiconductor chips, networking equipment, memory, and they rent out that space, that computing power, to businesses and consumers for all kinds of everyday tasks. And so we, and the typical business, are the ones that are driving this growth. When you text or send an email on your phone, you see the autocomplete feature pop up. That's emerged, that's shown up on our phones over the last couple of years because of these really sophisticated AI accelerator chips made by NVIDIA. They're able to make more calculations per second, which allows the phone to make these really quick recommendations for how to finish your sentence or finish your phrase. Similarly, social media, Facebook, Instagram, whether you know it or not, most of you are spending a couple % more time using those apps today than you were a couple years ago. The advertisements have gotten better and more relevant for you. The feed, the content, the videos are getting more relevant and better. They're able to analyze more of your data quickly as you scroll through to make better recommendations, which keeps you on the app for another % or two and makes you click on 1 or 2 more ads. And then finally, it's entering the physical realm as well. When I order a package from Amazon, which I do more than I'd like to admit, it's a robot that's involved in moving that product from a pallet in a warehouse onto a conveyor belt, into a package, sealed up, and put on a truck. That robot is calling on the cloud, getting its instructions, figuring out where in the warehouse this product is, etc. So all of these kind of simple, everyday things that we do are calling on the computing power supplied by these data centers using NVIDIA's chips and other companies' chips to do these tasks. AI is permeating really fast all of our lives and all of our daily flows. So what do these data centers look like? Here is downtown St. Louis. You can see on the right is Busch Stadium. If you go west 2 miles, you reach the old Armory, which some of you may remember as an entertainment venue. It's next to IKEA today. That's 2 miles. And then north to south, Energizer Park, the soccer stadium. If you go 1 mile south, you get to Lafayette Park. So 2 square miles. That encompasses a lot of St. Louis's downtown. There are data centers today, dozens of them, that are this big, just enormous in scale. This is actually a picture of one that was recently opened in northern Indiana. It's that size. This data center uses 1 gigawatt of electricity on a kind of average throughout the day. That's an abstract number. Nobody really knows what that means. If you compare that to St. Louis, so include the Illinois side, include St. Louis City, St. Louis County, Jefferson County, St. Charles County, our whole area uses 4 gigawatts in a year. So that's like the continuous amount. So this one data center encompassing 2 square miles uses a quarter of all the power that St. Louis's metro area filled with 3 million people use in a year. So these things are enormous. You can't just plop one down in the St. Louis area. Ameren wouldn't be able to power the thing. So when one of these are being built today, they're not just building these gigantic server halls, but they're also having to build new power plants to run them. You need backup power for these things because they can't go without power for even a minute. So these things are gargantuan. They use a ton of power, they're huge physically, and then finally they're also exceptionally expensive to build. This thing in northern Indiana, it cost $10 billion to build this infrastructure, put up the walls, build the buildings, do the earth moving, etc. And then the NVIDIA chips, the networking gear, the memory, that costs $30 billion. So the contents inside are where most of that cost and value resides. And that doesn't even include the power plants and the things you need to build next to it to make this possible. So just exceptionally expensive. And you can see how this level of spending is helping to drive our economy, grow our economy. In that Bloomberg clip, we talked about comfort systems. They're installing a lot of the electrical and HVAC and air conditioning equipment they used here. So this is just a huge growth driver for our economy, and we are the ones using all of this new computing power. I think I said this was an Amazon facility. Amazon is the biggest overweight in our Argent large cap strategy. We care a lot about it, follow everything they do. We actually sent one of our senior analysts to the grand opening for this facility, and they took this undercover video.
Everybody come on quick, look at the lights!
Has anyone not seen this movie? Logan in the back has his hand up. I know there's 1 or 2 people in that room over there that don't have their hand up too. Steve mentioned we gave this presentation to some younger advisors yesterday, and a handful of them didn't know. They should have been so embarrassed. I talked to a couple of them afterward. Get this done by Christmas. It's a wonderful movie. So we've talked about, we're building these huge things. Why do we need so many of them? Why are they so huge? The reason why is because the demand for these tools, these capabilities, is growing incredibly fast. It's growing faster than some of the fastest growing technologies we've ever experienced before. Here you see this chart, and it shows the revenue growth from infancy of some of these really fast growing technologies in the past. On the far right is Facebook's growth. You can see it looks like 9 years for it to achieve $15 billion in revenue. Google, meanwhile, the search bar, took 7 years. ChatGPT, owned by OpenAI, has done this in just 5 years. So it is the fastest adopted, the fastest growing technology we've ever had. And the amazing thing about OpenAI and ChatGPT is 95% of the people who use it do not pay. They do not contribute to that revenue number. It's only 5% of the users that pay for the extra fast version or the most updated model. Over the next couple years, OpenAI will start to add advertising and affiliate links and things like that for the free users to start monetizing and generating revenue on those folks, which will allow that revenue curve to go up at a really astronomical rate. Argent, across all of its strategies, has invested in a bunch of businesses that benefit from AI. We view these businesses, though, we evaluate them in the exact same context through which we view and evaluate all the other companies in the universes that we consider. We're looking to buy enduring businesses. That's a vague and generic term, but for us it means something really specific. An enduring business is one that we expect can grow, not just in 1 year or one economic environment, but kind of over the full market cycle. We're also looking to buy businesses that have a competitive advantage that helps protect their profits and their business from peers that might encroach on them and try to take their opportunities. And then finally, we like to invest with management teams that have a track record of running the business successfully, but also taking the company's profits and deploying them in shareholders' best interest. For some companies in some situations, that means building a new data center to help them grow. For other companies in other situations, it might mean paying a dividend. But not all AI companies meet that enduring business criteria. Many of them do not. One example of one that doesn't are quantum computing businesses. Most of those quantum computing companies, in fact, all of them, don't actually have customers. They don't generate revenue today. They don't have a competitive advantage. So we rule those companies out and have kind of sat out those stocks being some of the best performers in the entire market this year. We're trying to hold steady to that enduring business philosophy. And we've found, as you can see, a whole bunch of businesses that are growing thanks to AI that do meet that standard. Comfort Systems is one of them. When most people think of HVAC equipment, air conditioning equipment, they think of this thing, which sits outside my house. Sounds simple, sounds easy, can't possibly be a good business behind this thing. But what Comfort Systems really does is install systems like this. Air conditioning equipment that powers very important infrastructure. A data center that can't go down for a minute. A hospital, same thing. The most demanding and sophisticated businesses in the world choose Comfort Systems to install this really essential equipment. And that's what makes it an enduring business for us. So with that, Logan, I'd like to turn it back to you to close us out.
Thanks, Jed. Someone was asking me before the presentation how much of the slides were done by AI. And it's not a lot, but the pictures did turn out pretty good. These are AI generated. So we talked at the beginning, I think we've hit it throughout. This is going to happen unevenly. It's going to affect different industries and different people at different times. But AI is having an effect already. I don't know if you saw the labor number this morning. It's actually kind of disappointing. It's actually very disappointing. We have the most unemployment claims since the very beginning of COVID. That was the number this morning. And maybe you all didn't pay attention because I think everybody in the room here is either 55 plus in green or 25 to 54 years old in gray. We're good. We're unaffected. The problem is if you have a child or grandchild who's younger. So the 20 to 24-year-olds, the unemployment rate's gone from just over 5. The new number is just shy of 10, so it's almost doubled. And if you think about it, it makes a lot of sense. What AI can do is a lot of like auto processes, entry-level data, drafts of documents or letters, whatever that might be. That's what AI is great at. And it's hard to know exactly how much of this jump can be attributed to AI, but I think it's fair to say that at least some of that jump is because of AI. So that's one unintended consequence so far. There's a few other unintended consequences too, and the reason we're doing this is we saw it with the internet as well. Unintended consequences like social media having an effect on our brains, and maybe it changed how we consume news, and if that's good or bad for society, who knows. But one of the good things about AI is self-driving cars. So through financial advisors we work with, I know of at least 3 cases of people that have bought a Tesla with the self-driving capability because they were afraid their kids were going to take their keys away. And it allows you to get safely from home to wherever you want to go. If you haven't been in a Tesla self-driving car in the last 2 years, it's unbelievable. You just poke your destination and it goes. It's really, really great. Just last week, Waymo announced it's coming to St. Louis. This is not a joke. That's actually what that car looks like. And Waymo is owned by Google, and this is one step further than Tesla. Tesla, you have a driver in the driver's seat. There's not a driver in the driver's seat. So another unintended consequence is actually, this is our first like America's Funniest Home Video that we ever have. This is actually Steve's neighbor named Sarah, who's in her Waymo for the first time with her husband filming her in the back seat. Let's take a look.
Sarah, what's your observation?
We're gonna have to pause this in a second. It would eliminate you and I fighting in the car. I can't get mad. There's no one there to get mad at. Think of how many times I got upset with you with your braking and everything you did today. I can't get upset because nobody's there. This could save marriages.
That should be their tagline. This car saves marriages.
This could totally save marriages. That's totally.
And as someone that's recently engaged, I might need to buy a Waymo and maybe have some success. But anyway, that's another unintended consequence of AI, and there's going to be a lot of them. But to sum things up, and we're going to be happy to take a few questions, we're really excited about AI technology. We know it's going to take longer to roll out than some are predicting. We know it's going to affect things in different ways, but we have allocated your portfolio as best we can to take advantage of this technology, and we're going to continue to make those shifts going forward. With that, I'll do the quiz. Let's see, real fast. ChatGPT, 800 million people. Amazing. NVIDIA, profits D, 2 days. Largest company in 1975, General Motors. And the market cap is a little bit bigger than Germany. It's unbelievable. So Germany, the entire economy, and then one company here, about equivalent in size in terms of the economic impact. So with that, any questions? Yeah.
So I recently read a book called The Coming Wave by Mustafa Suleyman, who started DeepMind AI and then sold it to Google, and now he's got another AI company called Inflection. He's very concerned about the potential risk of AI and AI getting to the hands of some rogue dealer shutting down all kinds of websites and power and power grids and this sort of thing. What type of regulation of AI are we likely to see? I know there are some states that are doing this, and the federal government says, no, we're in charge of that. Where do things stand and where they might go?
That sounds like a good question for Jed. The question is how are we going to regulate AI so that it doesn't get in the hands of bad actors and maybe things aren't as problematic in the future?
Yeah, first disclaimer, not a lawyer. You're right, a number of states have passed laws kind of like regulating AI, trying to protect minors from it, for example, things like that. Colorado, I know, is one that's passed such a law. There is a group in President Trump's administration. David Sachs is kind of the lead person that's leading that group. He's the AI czar for President Trump's administration. His preference is to have national, federal regulations instead of state by state. And the reason he wants that is because it will be difficult for both established and big AI companies, but also especially the new ones, to comply with 50 state-by-state regulations that might say you need to do this for kids age 9 and under, and then another state is 11 and under, etc. You can see how that would get complicated really quickly. So there's a debate in America. Should we regulate this at the state level, or should it be regulated at the federal level? And then there's also arguments about, should this be regulated at all? Because if we do regulate it, it might slow our progress. China and other countries are also rushing to develop this technology as quickly as they can. This technology has national security and defense implications. Some of the primary use cases are in drones and things like that. So it's a really active debate. I don't see many decisions at this point, and states have moved ahead and started passing their own laws. And now the question is, will the federal government preempt those laws? So yeah, really active debate playing out right now.
Carol?
I would like to know how many employees work in that huge data center in Indiana.
Yeah.
Will you repeat the question?
Oh, yes. The question is, how many employees actually work on a daily basis in that data center Amazon runs in Indiana? The answer is, to build the thing, it's like 5,000 people a day for 18 months. After they get it built and opened, it's under 100. They make noise. They obviously use up a ton of energy, which sometimes increases the utility bill for people that live in that community. A lot of you paying attention to the news in St. Louis know that the St. Louis area has denied the application for some of these data centers for those concerns. So yeah, these things, they're really big. They do contribute a lot of money back to the economy. They pay property taxes on these huge facilities, so they do contribute to the community in that way. But they do not employ a ton of people. It's kind of like a cell phone tower. Once they build it, you just need somebody to mow the lawn, and that's about it,
We'll take one more.
Yeah, so how are we going to power all of these data centers? Do we have enough energy? Is that enough place to invest?
Yeah. So the question is how are we going to power all of the data centers? Do we have enough energy? And if not, how are we going to get there?
Yeah. America is short power, electricity generation. And that's in contrast to China. It's kind of interesting. We have the semiconductor chips, but a shortage of energy. China has a ton of power generation, but virtually no sophisticated chips. So we're both kind of short in one area, and we're both trying to cover our weakness as quickly as we can. China's trying to develop their own advanced chips, so far really struggling to do that, but making some progress. And America is rushing to build electricity generation as quick as possible. For the most part, that's a multi-year process. Building a power plant takes a long time. The quickest way you can build one is to build one that's powered by natural gas. And so we're seeing a lot of natural gas power generation being built in America today. The second fastest is solar power. And you see a lot more of those built as well. Oftentimes these data centers are built with solar power right next door. And then nuclear, which the stock market is excited about, right now at the moment, is a much further out technology. Those facilities take years and sometimes even decades to build, and sometimes you try to build them and you don't even get to the finish line.
Well, thank you all. Jed and I and Ken and Steve are going to be up front if there's other questions. Again, happy holidays, happy New Year, and we look forward to seeing you in June.